As a young person, the thought of paying life insurance premiums until age 100 or 121 can seem a bit daunting. I mean, who makes commitments for that long, really? But here's the secret. There are limited pay policies that are paid for X amount of years. These policies can be a great saving solution for young people, and we're gonna talk about why today. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel. And don't forget to hit that bell to be notified when we upload new videos twice every single week. A limited pay policy could make sense in a lot of situations, but it especially makes sense when you're dealing with these specially designed whole life insurance policies designed for cash accumulation.
By its nature, a specially designed policy for cash accumulation puts extra money into the policy. And a limited pay policy has extra premium because you're shrinking down the amount of years in which you're paying the premium from age 100, let's say, to age 65, or for a 20-year period or a 10-year period. The lower the amount of years of funding, the higher the premium. But again, if you're designing a policy for cash accumulation, a limited pay policy makes sense because it puts you in a position where, let's say, a life paid up at age 65, there are no more premiums due after age 65. Now you're collecting checks instead of paying premiums.
But let's take a step back. We're saying a higher premium, and what we mean by that specifically is it's a higher premium for the set amount of death benefit, which isn't necessarily a problem when you're designing these policies for cash accumulation. You're focusing on the cash accumulation versus the death benefit. And many people, when they're young, they don't have a great need for death benefit, so it's really not a deal breaker.
But the key is you'll have the death benefit at your life expectancy when you'll need the death benefit the most. And consequently, if you have a limited pay policy, again, let's say a life paid up at age 65, by the time you're 85, there will have been 20 years where you didn't have to pay any premiums, but you had a completely paid up death benefit that's actually growing every year because there's no cost of insurance dragging the return or the growth of the policy.
In my case, I started limited pay policies years ago, and it was a simple way to get started with saving. I put away $500 or $1,000 a year into these policies, and in 10 or 20 years, they're gonna be paid up completely, and the cash value and the death benefit are going to continue to grow and accumulate interest and dividends throughout my entire life, even after the premiums aren't being paid anymore.
But keep in mind, there is a trade-off with a limited pay policy. And what the trade-off is that's less money that you could stuff into the policy for any given death benefit. And what that means is your cash value will be slightly lower in the earlier years. But then you have to weigh the cost of having less cash value in the early years versus the benefit of having no premiums in the later years.
Leave us a comment down below. What pros and cons do you see with using a limited pay policy? But let's take another step backwards and think about compounding interest. Compound interest curves require two factors: time and money. We all know we could never get time back, and it's important to consistently put money into these policies to accumulate the best compound interest curve possible. But with a limited pay policy, you're limited on how much money you're able to put in. So again, in my situation, what I do is I have a term policy that guarantees convertibility of that death benefit, and I could create more whole life policies throughout my life as my budget allows. So as I pay up policies, I have the cash flow to now convert a piece of my term policy into a new whole life policy and start the cycle all over again.
But the key is she'll be building capital that she could access everywhere along the way to take care of the things of life, whether it's buying a car, whether it's going on vacation, or moving across the country.
Not to mention for business opportunities. These policies are great for entrepreneurial type people. You have full liquidity, use, and control of that money to take advantage of business opportunities that come about, so you could earn an internal rate of return within the policy and also an external rate of return by starting your own business and putting that capital to work for you without interrupting the compound interest curve, which is key.
Nelson Nash, the author of the best-selling book, Becoming Your Own Banker, put it so eloquently. When you have access to money, opportunities will find you.
If you're considering a specially designed whole life insurance policy designed for cash accumulation, whether the traditional design or a limited pay policy to meet your needs, visit our website at tier1capital.com to get started with your free strategy session today. You can hop right on our calendar, or if you'd like to learn more about how we put this process to work for our clients, check out our free webinar, The 4 Steps to Financial Freedom. It's right on our homepage. Also, if you like this video, please be sure to give us a thumbs up and don't forget to subscribe.
Thanks so much for watching our video, and remember, it's not how much money you make.
It's how much money you keep that really matters.